Okay, good afternoon, sir. So today, me, Satyam, Ninad, and Prakhar will be presenting our topic on capital budgeting. So first, we'll take the overlook of what we will see in the capital budgeting. So there is the definition of the budget sector. There are many types of budget, capital budgeting, importance of it, capital budgeting in some categorization, capital budgeting 8 steps, and then we have some evaluation criteria. Okay, so firstly, we will take a look on what is the budget. So, if we talk about the definition of budget, so budgeting is a management tool for planning and controlling future activity. So, financial words is a plan for saving, borrowing, and spending. So, a budget is a financial plan and a list of all planned expenses and revenues. Okay, so in the budget sector, we have many types of budgets. So basically, we have basis of three. The first is basis of flexibility, second is basis of time period, and third is basis of functionality. So the basis of flexibility is fixed and variable budget, and on the basis of time period, it is maybe a short term or a long term budget. On the basis of functionality, we have sales budget, production budget, marketing budget, project budget, revenue budget, and a lot more.
So now capital budgeting. So capital means the operating assets used for production, and budget means a plan that details project cash flows during some period. So by combining the two words we get capital budgeting, which means as process of analyzing projects and deciding which ones to include in capital budgeting. Now the importance of capital budgeting. Here are the follows importance of capital budgeting. The first one is the growth. The second one is the large amount. The third one is invisibility. The fourth one is complexity. The fifth one is risk. And the sixth one is long-term implications. Now the benefits of capital budgeting decisions. Capital budgeting decisions evaluate a proposed project to forecast return from the project and determine whether the return from the project is adequate. Capital budgeting decisions evaluate expenditures decisions which involve current outflow of funds but are likely to produce benefits over a period of time more than 1 year. Now the capital budgeting project categorization. Here are the few steps. The first one is establishment of new products and service. The second one is replacement projects, maintenance or cost reduction. The third one is explanation of existing projects. The fourth one is research and development projects. The fifth one is long-term contracts, and the sixth one is safety and or environment projects.
So here are different investment criterias, discounting criteria and non-discounting criteria. The subcategories of discounting criteria are NPV, that is the net present value, benefit cost ratio, and IIR, that is internal rate of return. And the subcategories of non-discounting criteria are payback period and accounting rate of return. Next slide, please. So the payback period is defined as the number of years required to recover the original cost invested in a project, and it has a condition that the cash inflow is constant every year, and the formula to calculate the payback period is cash outflow upon cash inflow. And here's an example that explains us the payback period, which is 2.7 years. Next slide, please. The average rate of return means the average annual earning on the project, and under this method, profit after tax and depreciation is considered. And this is an example which shows us the internal rate of return and annual rate of return. Next slide, please. And discounted payback period method. In this method, the cash inflow are discounted by applying the present value factors for different time periods. And for this, the discounted cash inflow are calculated by multiplying the present value factors into cash inflows and required inflows. Next slide, please. And profitability index as the net present value method, it also shows that project is accepted or not. If profitability index is higher than 1, the proposal can be accepted or else not. Thank you. Now I'd like to call upon Satyam to explain this some examples.
So let's see an example. So we have taken 5 years. Regarding the 5 years, now we will say the following cash flow for the following years. There we have taken out the cash outflow, that is 1 lakh rupees. With that, the cost capital is also 10%. Now we will calculate the following NPV, probability index, IRR, payback period, and discounted payback period. So first one is the NPV and IPV. So here we have taken the following data with the cash flows, and we have reduced the PV rates, and after reducing it we have got the PV of cash flows, and through that we have less than the cash flows. So NPV will be deducted by 1 minus the following outcome we have got. Next. And for calculating the IRR, we have to take the PV factors that we have calculated in the previous, and to get the cash flow, we have to reduce it by the 18% cash flows. And to calculate the final result, we have to reduce the NPV we have got and add it to the next slide.
Now,
So the formula we have used here is the IRR, which is NPV of higher rate upon difference in cash flows and difference in the rate. So with now let's take an example like IRR minus 19, where the 750 is the higher rate, and we have multiplied by it, the difference in the rate with an example of 1. So the difference in the cash flow we have got is 2500, and we have also calculated the IR in the percentage.
so now the computation of non-discounting payback period. Here is the data. The first one we have got the year. The second one we have got the cash flows, and third one we have got the cumulative cash flows. Now to calculate the PBV, we use the formula completed years plus required inflow by inflow of next year into 12. So we have taken the third year. So in that, the PEV equals to 3 years plus 1, 1 lakh minus 90,000 into 50,000, which equals to 5.4 years. Now the computation of discount payback period. Here is again the data. We have got the year cash flows, factors, PV of cash flows, and cumulative cash flows. So PAB equals to completed years plus required inflow into 12 divided by inflow of next year, which equals to 3 years plus 1 lakh minus 73,000 upon 3,000 34,150 into 12, which equals to 12.48 years.
Okay, so in the end, we would like to conclude our presentation. So basically, we have studied various evaluation criteria for capital budgeting, and generally, an impression created that the firm should use NPV method for decision making. So most of the larger companies consider all the measure because each one provide somewhat different piece of relevant information to the decision maker. Thank you.